Hello and welcome back to the non-qualified compensation and benefit portion of the class. This is week 6. Scott Rowland back here speaking with you. Last week we covered a number of the kind of larger global issues related to these kinds of plans. We didn't talk at all really about stock or equity plans, so we're going to cover that this week. But we're also going to cover some more detailed accounting and tax issues that are inherent in any kind of a non-qualified plan. So to start with the accounting discussion for non-qualified plans, if you remember last week we mentioned that qualified plans are off the books of the company. Those plans are separated once contributions are made to them by the tax and regulation rules regarding qualified plans, which is why they are not subject to the risk of bankruptcy of the corporation. Conversely, non-qualified plans remain on the books of the sponsoring company, and any liabilities associated with them and any assets that are set up for informal funding all remain on the company's books. So there are accounting transactions, both income statement and balance sheet, that affect non-qualified plans in a very different way than qualified plans. Qualified plans are simply an expense, and once the contribution is made each year, the expense just flows through the income statement, and that's the end of it. There's no liability. Non-qualified plans create the same type of annual expense, but that expense creates an on-balance sheet liability as opposed to just being completely separated. And importantly, if you recall from week 5, we talked about informal financing, the use of rabbi trusts. Those trusts, remember, are on the balance sheet of the corporation, just sort of a fence or a different pocket for the company regarding assets for the plan, but they don't change the taxation or accounting of the plan or the assets. Continuing on with the employer's consequences for non-qualified plans, besides the accounting impact we just covered, there's also the tax issues, and we've talked about those some in week 5, but it is a good reminder, and I always like to revisit these things, and we do this the same way in our consulting process with clients to help everybody remember how this all works. Okay, so for a non-qualified plan, actual tax deductions occur at the time that benefits are paid to participants. It's technically, the deduction occurs at the same time participants pay tax, which in a properly designed plan would be at the time of the benefit being paid out. That's that constructive receipt comment and concept we talked about in week 5. Whenever there's constructive receipt and therefore taxation for participants, that's when the corporation gets the tax deduction for paying the compensation. The second bullet point, factors to consider whether there's a flow-through taxation kind of entity. If you recall, we talked about partnerships, S-corps, LLCs, sole proprietors, any of those kinds of businesses that don't file a separate tax form or tax return like a C corporation does. Publicly traded companies are all C corporations. So the corporation itself has a tax return and pays tax, and then it distributes earnings through dividends to shareholders who then might pay tax on dividends. Any other entity, S-corps, LLCs, partnerships, etc., they do not, at an organizational level, file a tax return. All of the taxable income from those entities flows through, that's the reason for the term, to the owners of the business directly, to the shareholders. So there's no corporate tax paid and then a separate individual tax. It's all taxable by the owners at their level. And that's why, it's important when companies are thinking about non-qualified plans. Most businesses are these flow-through kinds of entities. You'd be really surprised at the size and number of really large S corporations, even here in Minnesota, but certainly in the United States. Many, many companies that are large corporations are not C corporations. They're all privately held, but They do that so that they can control the taxation directly to shareholders and not have to worry about outside shareholder issues and as many corporate tax issues. But because of that structure, owners of those businesses oftentimes will think, hey, maybe a non-qualified plan is a good idea for me. Well, a non-qualified plan for the owner of the business, again, when the owner equals the taxpayer, either directly or indirectly through the corporate structure, a non-qualified plan generally doesn't make a lot of sense. Again, because the business, there's no upfront tax advantage for the company as though there is for the participants in a plan that aren't owners. So that's really the biggest consideration is majority owners in these kinds of companies don't really benefit directly from non-qualified plans. Their benefit comes from helping their key employees generate tax-deferred income and reward them indirectly that way. Again, a little more review, but now we're going to switch gears to employees, the employees' tax consequences in a non-qualified plan. And again, I mentioned this earlier, but it's all on one slide here for you. So, taxation for an employee in a non-qualified plan goes along with the timing of when the employer gets its tax deduction, and which is again different than in a qualified plan. So non-qualified plans, if you think of two fists pushed together, one of them being the tax owed and one being the tax deduction, those fists stay together in a non-qualified plan, and that's the way the United States tax code works in general. However, in a qualified plan, a tax qualified plan, that's why they're called that, those fists get pulled apart because the employer gets a tax deduction today when it makes the contributions to the pension or 401k plan, but the employee doesn't pay tax until later, and that's the tax timing difference that is allowed in tax qualified plans, but that's the timing difference that is not allowed in non-qualified plans. So to build on that thought then, the employee's year of taxation in a properly designed non-qualified plan will equal the year that they are actually paid money out of the plan. So again, properly designed means we stay within the rules of 409A and regulations, and therefore employees pay tax when they're paid something, so a company can pay benefits out of a non-qualified plan over a period of time. It doesn't just have to be a lump sum distribution. In fact, many of these plans will pay out over 5, 10, even 15 years after someone retires, and the only portion that's taxable is the piece that's paid each year. The remaining balance in the plan remains tax deferred until it's paid out later. And that constructive receipt concept is the key one to avoid taxation. And as I mentioned before, in a for-profit company, remember what that barrier is to constructive receipt. It's the risk you might not get all your money if your company goes bankrupt. So that's a review of employee tax consequences. Continuing on the tax theme, it might seem like we're talking a lot about taxes, but as you can imagine, taxes are one of the primary driving forces in the creation of non-qualified plans, or at least the delay of taxation. So income tax withholding rules, again, non-qualified benefits are subject to federal withholding when they're paid, when they're added to wages. In fact, payments out of non-qualified plans are required to be paid via W-2 wages because companies are required to do the tax withholding. They're literally deferred compensation and therefore subject to federal withholding rules. Most states also follow that logic, so state and federal income taxes should be withheld by companies when they're paid out. And the timing, again, is really the second bullet point, number 2. It's the lapse of the substantial risk of forfeiture. So in a for-profit company, in a properly designed plan, your risk of not being paid ends when you get paid. It's actually pretty straightforward as long as the plan complies with all the other rules and regulations we've talked about. So to go along with the fact that there's a federal withholding required for state, and it's not just federal, sorry, income tax withholding required for federal and state purposes, on the next slide we'll talk about other payroll taxation. So switching gears away from income taxation, which is really the driving force in plan design for non-qualified plans. We want to make sure we do the plan design correctly so that income taxes are delayed until benefits are paid. We can't really make that work with FICA tax, and if you are familiar, FICA is the Federal Insurance Contributions Act, and it covers both Social Security and Medicare payroll taxes, so that's both pieces. Social Security, of course, has a limit on how much compensation is subject to that tax, which is 6.2%. Medicare payroll taxes, however, there's an unlimited tax. There's no limit on the compensation subject to the Medicare's 1.45% tax. And there's also, with recent tax rules and regulations, there's also a 0.9% surtax related to Medicare for compensation over, I believe it's $200,000 or $250,000 for a couple. Those taxes all still apply, and they apply when the benefit amounts are vested to participants. So this is generally, as you can see in the second bullet point, different timing than income taxes. So we design a plan with conscious of keeping income taxes payable at the back end when benefits are paid out, and then we just simply have to report and react to when FICA taxes are owed. So the bottom bullet point's an important one. And if I can work this correctly, I'll see if I can get the underline to work. Let's see. This is the same treatment as 401k contributions. So that's an important point, and here's why. If you participate in a 401k plan, and let's just use some round numbers. Let's say you put $10,000 into a 401k plan in a plan year, and you don't have any other deductions going on, so your W-2 is clean and there's no other pre-tax or deductions. What you would find on your W-2 at the end of the year is you would have $10,000 more taxable wages in your Social Security and Medicare boxes, those are boxes 3 and 5 on the W-2, than you would in the income tax boxes, in box 1 for federal tax and lower on the W-2 for state taxes. That's because your contributions to 401k and any other kind of a retirement plan that you make are subject to FICA withholding when they're earned and vested, and a voluntary contribution, certainly to 401k and generally to any non-qualified plan, is always not subject to any vesting. So you're always vested, and therefore you're always paying FICA tax up front. Now let's jump back up to the top of this slide and think about the comment about when vested. You've heard me talk about in the plan design process that, sometimes companies will put vesting restrictions, especially when there's company money involved in a plan like this. Well, then the FICA tax is triggered as vesting increases, not when the company's actually making contributions. So a common vesting schedule might say, you're vested 20% per year over the first 5 years of the plan. What that means then is, as somebody's vesting goes from 0 to 20%, the 20% vested value of their account is subject to FICA tax in whatever year they became vested. The following year, then, as they become 40% vested, now the new increase in the vested balance is subject to FICA tax, and so on until they get to 100% vesting. So that's the difference. There's a timing difference in FICA taxation versus income taxation. This doesn't generally get overlooked, but it's easy to overlook if advisors aren't helping companies think about these issues properly. And this is not a new rule. This is not related to 409A or any of the other deferred compensation tax rules that are so prevalent and in everybody's for awareness. This is an old rule that hasn't changed. Okay, finally, moving a little bit away from taxation, because that can be a little dreary, but nonetheless very important to pay attention to. 409A requires non-qualified plans and other rules besides 409A require some other things of non-qualified plans. First thing, they must be in writing. And it's more than just a one-page agreement. There are some specific elements that need to be added to the plan documentation. And so a properly drafted non-qualified plan document now is going to be several pages because there's lots of boilerplate legal requirements that have to exist in that document in order to qualify under 409A. Non-qualified plans also require a one-time Department of Labor, that's the DOL second bullet point here, Department of Labor notification / disclosure. The required timing is within 120 days of plan adoption. And actually now the DOL has a electronic website where companies can register their plans online. It's quite simple. You fill in 4 or 5 chunks of information, taxpayer ID for the company, name of the plan, number of participants, etc., and file it, and almost instantaneously the company gets back a notification of receipt and the fact that the disclosure requirement has been met. That's not the same as obviously a 5500 or an annual return, and it's the only requirement as long as that timing restriction of 120 days within adoption is completed. After that, there is no other ongoing reporting required to the Department of Labor for a plan like this, and no requirements to report to the IRS for plans like this. Other documents that go along with a legal plan document include things like a beneficiary designation form, distribution election forms, if there are those kinds of options in the plan, and a deferral election form. If it's a plan where people are voluntarily choosing to contribute, much like the 401k plan, you need to fill something out to tell the company how much you want to contribute. So those kinds of documents are very, very similar to how 401k works and are required under this construct. For publicly traded companies that have registered securities, there is also a Form S8, which is basically an information return required with the SEC, because if you think about the legal status of being an unsecured creditor of a corporation, which is the legal status of these non-qualified plans, in a public company, you're almost like a bondholder. So that's the way the SEC views it, and that's the reason for the information return related to non-qualified plans. Again, only for publicly traded companies. If the company doesn't have other registered securities, is completely privately held, there's no SEC requirement. Okay, so we've talked a lot about generic specifics and rules and regulations and taxes, but let's go over a case study for a kind of a typical non-qualified plan for a privately held company, just to get a sense for what do companies think about and why, and how these plans can really apply in the real world. So here you see some facts. It was privately held, manufacturing, construction company. Type of company doesn't really matter. About $100 million of revenue, so a nice sized business, but not a Fortune 1000 company by any means. And you'd be surprised the number of $100 million companies exist that you've never heard of before. Or you've heard of them, but you had no idea they were that big or that small, frankly, either way. The company's concern was twofold. Being a manufacturing kind of construction company, they were obviously thinking about their key people, their senior management, but they were also actually probably more concerned about mid-level management folks, project managers, plant managers, those kinds of folks. These are relatively middle class, maybe upper middle class depending on the company, but probably middle class kind of people. And so these are not necessarily, when we talk about non-qualified plans or executive level benefit things, that's maybe not a group of people that you might think about. In fact, in some of the in-person versions of this class that I've taught, students have said, well, you're just talking about making rich people richer, right? And actually, no, that's not what we're talking about. Certainly, some folks who you would consider rich are going to be involved in plans like this. And the only reason they're involved in plans like this is because qualified plans have limits on them, and the company can't do anything else. It's the only choice they have based on government regulation. But plans like this, certainly in mid and smaller size companies, really end up benefiting mid-level folks even more than quote unquote, upper level rich people. Now, this company already had a competitive package of salary, bonus, and basic benefits. So 401k plan, health insurance, those kinds of things. And I'm going to move to the next slide right away here. Talk about a buzzkill. It's intermission time. No, let me just move on to the next one here. Okay, continuing the case study. So, a small, mid-sized company with middle-level folks that are already being paid competitively, but this company was worried that a couple things. They didn't want to lose their plant project manager kind of folks to competitors, because that's obviously a problem. They're trying to retain them. But they're also worried about providing some security for these folks, so those folks can feel both secure in their jobs, but also their families can feel secure if something happens to them. So we helped this client design a package and benefit program that includes these main plan design elements. Pre-retirement survivor benefit. So if they were to die while they're working, their family would get a stream of payments over 5 years to help provide supplemental insurance, income replacement for that family. There's a supplemental retirement benefit, so that if you don't die while you're working, then you get an additional retirement benefit. And that was really the main goal of the program. And then there was also an option for folks who were being cut off in the 401k because of the limit to contribute voluntary compensation above and beyond the 401k plan. That deferred compensation benefit, the voluntary piece, in the second bullet point here, was actually offered to a smaller group than the whole package plan. And that's because as you get further down in the organization, and when I say down, into lower compensation levels, the 401k plan limit doesn't really affect as many people the further down you go, because folks are able to contribute a meaningful percentage of their pay and not hit the limit. So the voluntary piece was mainly offered at the upper level of folks, but the other pieces, the survivor benefit and the supplemental retirement benefit provided just by company dollars, those went further down in the organization. This plan, both pieces, the retirement piece and the deferred compensation piece, were financed with a rabbi trust that owned corporate-owned life insurance. Inside of it, the insurance provides a way for the company to recover costs if somebody were to die pre-retirement and give it cash to pay those benefits out. And then if somebody doesn't die, which most people don't, it gives the company a way to generate growth on its contributions in a tax-deferred way to be able to pay the retirement benefit. And just as a final example, we did have a person die in the last few years in this plan while they were working. And that person, there was an insurance policy on the life of that person, so the company recovered the insurance benefits, and those benefits were tax-free to the company, which provided it with a pool of money to pay out for 5 years the salary continuation. This person's spouse got essentially almost all of that guy's, it was a guy that died, salary paid annually for 5 years to his spouse. And I got a call a couple years into that when the spouse's brother, so the employee's former brother-in-law, called and said, I want to thank you so much for this plan, because it's given my sister a 5-year period of time when she didn't need to worry about where money was coming from. They're not independently wealthy, but it took that financial burden off of her plate, gave her time to deal with losing her husband prematurely and figure out where to go next with life. And I said, thank you, but you should actually thank the company, because it's the company that paid for and provided the plan. We just helped design it and administer it. But that's an example. This is not somebody who was making hundreds of thousands of dollars a year. It was probably somebody making about $90,000 a year, which is a nice level of compensation, but it's not. You're not buying vacation homes and Mercedes Benzes with $90,000 a year when you're supporting a family and paying for college, etc. So mid-level people that don't make millions of dollars are very much beneficiaries of plans like this. And that's something that's not always intuitive when we talk about worrying about tax avoidance and things. So that's a key element that I want to leave with you in this process of thinking about how these plans can benefit small and mid-sized employers and their employees. Okay, we're going to switch gears, and I should probably talk to Professor Clark about moving the intermission slide to before this one, because we're going to switch gears away now from the concepts and plan design issues of kind of basic non-qualified plans and tax and accounting and all that stuff. We're going to switch to equity-based plans. And if you've noticed the bullet points that are in bold, phantom stock and stock appreciation rights, there are non-qualified plan versions of stock equity-based plans as well. So switching gears now, shift your mindset from kind of deferred compensation and retirement plans to equity-based plans, and that's where we'll continue on here in the discussion. Stock options are actual rights to buy company stock, as you might imagine, at a fixed price. They are established when someone is granted some stock options. It's a document you receive that says here's the date of the grant, here's the number of shares of stock you are allowed to buy at the fixed price. Generally, that's the market price on the date of the grant. And you have a fixed period of time when you are eligible to buy those shares at that price. This is a very inexpensive way for companies to offer potential ownership to employees. It's not current ownership because it's just a right to buy stock. It's not actual stock at the time of the grant of the option. And it requires, however, that owners are willing to share actual ownership with employees. And this is where, public companies have no problem with that because there are, millions of shares flying around in the markets, and this is a common way to compensate employees in publicly held companies. But in privately held companies, which is, again, most companies in the world, those owners aren't necessarily planning on or wanting to offer actual equity ownership to key employees. I like to sort of ask companies to think about their ownership issues on one side of the table and their key employee compensation issues on the other side of the table. And if those are big circles, if you move the circles towards the center of the table, sometimes there's some overlap between those circles, but it's generally cleanest and easiest if there is no overlap, so that ownership can deal with its ownership issues however it needs to, whether those people are also employees or not, and then you can deal with employee compensation issues separately. That is the simplest way to keep both pieces operating exactly as everybody intends, without running into conflicts of interest, etc. And because we're going to focus on the non-qualified kind of plan design aspects of options and equity in this class, I'm not going to go further into the rest of the stock option, incentive stock options, restricted stock elements, because those are all actual equity. And as I mentioned, private companies, especially smaller and mid-sized private companies, generally aren't interested for lots of reasons in actually offering equity to people beyond the ownership group. So we're going to focus now on phantom stock and stock appreciation rights, which are ways for privately held companies to get to the same kind of reward structure as actual equity, but in a non-qualified sort of way. So moving on, let's go to phantom stock. This is not a Broadway play. That's a terrible joke, but it's not. It's a way to pay somebody some compensation in the future based on the growth in the value of the business, or some measure of value of the business. So let's kind of cover the slide here. First of all, on the left side, the key elements. A participant, a key employee in a phantom stock plan, gets some value of the company. Maybe it's actually based on a value of stock. Usually it's not, doesn't go all the way to a stock price, but some measurement of the business value, profits or something like that. But there's no actual ownership rights. So there's no actual stock agreement. You don't go to shareholder meetings as a participant in a plan like this. It works really, that second bullet point under key elements, it's a non-qualified plan. So it's subject to all of the 409A rules, all those tax and other rules we've talked about. But instead of it being like a voluntary deferral plan where maybe you put your own money in, and then you grow your funds based on some mutual fund like rates of return, this money is generally company provided, but not always. But then it grows or doesn't grow based on the performance of the actual value of the company itself. So that's the difference. It's the linkage to maybe both the contribution being based on performance of the company, but certainly the growth in anything you have as a participant in this plan being linked to the value of the business going forward. On the right side then, the taxation rules, again, these are just like any other non-qualified plan. We just have to think and apply them a little differently. Participants are taxed when plan benefits are received. Phantom stock plans generally pay out only maybe at retirement or if there's a sale of the business. I think maybe in week 5 we mentioned change in control kinds of plans. Sometimes phantom stock plans only pay out if the business is sold. So that would be a way for an owner to tell some key people, look, I'm not giving you real stock because that's complicated and we have family ownership already, but we want to take care of you if we sell the business. So we'll give you X% of the value of the business if we sell. And by the way, if you help us grow the value of the business, well, your X% will be worth more when we sell it. So that's the concept. And the tax, again, rules are all the same as for other non-qualified plans in terms of FICA taxation, income taxation, and importantly, when benefits like out of a phantom stock plan are paid out, they are tax deductible to the company that pays them because it's compensation. It's not actual equity. So it's taxed and treated as compensation, which creates tax for the employee as income, not capital gains, and it is deductible as compensation to the company at the same time. So here's an example of how phantom stock can work with some numbers and concept of timing and taxation. So for example, let's just kind of start in the upper left. A 1 share grant is made of 1 share of phantom stock to a participant, and we started the value of the business at $10 a share. And then we go down to vesting, and maybe the vesting was in 5 years, you become 100% vested. So now this person has become vested in their share of phantom stock, and they're eligible to get paid whatever value the phantom stock has. And we're going to, in this example, say the company has gone up in value to $50 a share. So if you go across to the right, there's no taxation for the participant and no tax effect for the corporation when the phantom stock is granted because there was no vested value at that time. Now at vesting, there's still no corporate tax impact because nothing has been paid out. It's just vesting that's occurred. Now the participant, however, has the right to the money at some point in the future. And if you remember under the FICA tax rules we talked about a little earlier in this week's session, we've now triggered FICA taxation. No income tax, but the full $50 a share is taxable for Social Security and Medicare purposes. So that would go on the W-2, this participant's W-2 in that year, $50 worth of FICA tax owed. Now, the participant doesn't get paid out yet. The company continues on, and now there's a payout event, whether that's because the business is sold or because the participant has retired or left employment. Now the value of the business is at $100 a share, and let's see what that means. And what it means is a couple of key things. If the value of the business is $100, and that's the value that's to be paid out, the corporation, of course, will make a $100 payment to the participant and take that full $100 as deductible compensation. That's the corporate side. The participant side, they will pay $100 or at least they'll have $100 of income taxable wages related to the payment from the phantom stock plan. Again, ordinary income taxable, but no more FICA tax on the second $50 of growth since vesting, because now they already paid their FICA vesting tax at the front end, which was when they became vested. So in that example, $100 is income taxable to the participant, but they only paid FICA tax on $50 because after vesting, there's no more FICA taxation, only on a new grant. So if they had been granted more shares, then those shares would have their own set of FICA tax and income tax schedules. But for this one share, that's how that works. Okay, let's build on this concept. So phantom stock, the example we just gave, it's kind of corollary to restricted stock in the real equity world, where there's a share value right away, and even if the company didn't go up in value, in that previous slide, if the company didn't go up in value from the $10 original grant price of the stock, that person still would have gotten $10 of value when it was paid out, because the share was worth $10 when it started, and that's where they finished. With a stock appreciation right, you can think of this as a non-qualified stock option. So over in key elements on the left, again, same kinds of things as phantom stock. It's paid in cash, it's not actual stock, no real ownership. But the biggest key elements, the first one, in that the participant is really being granted the rights to the increase in the market value of the stock or the company. Maybe not actually based on a stock price, but company value. But it's the increase only. So it's not going to be sharing in the current value of the business, but in the growth of the value of the business. And that's the key difference. Business owners in private companies really like this kind of structure because they're telling key people, look, we really want you to stay around and help us grow the value of the business, and we're willing to share in the growth of that value of the business. But owners also like the fact that if the value of the business doesn't grow, they don't owe any additional compensation. Owners tend to think, and mostly rightly so, that they're paying people in a competitive fashion today for the current value of the business. But they are not interested in double or triple paying for the current value of the business. They are willing and able, however, to pay for growth, and that's the concept. So then over on taxation, again, it's taxation is income tax, ordinary income tax, when the amounts are payable or exercised, quote unquote, if you kind of want to use a stock option kind of thought process. And again, the company, of course, gets a tax deduction equal in amount to whatever the participant employee is paying tax on. We'll switch to the similar kind of example here on the next slide. So we're going to use the same $10 grant price and $50 vesting, quote unquote, exercise timing as we did on the phantom stock piece, and see how this works. So if we start with a SAR at $10 a share, obviously there's no taxation today for employee or employer, because again, nothing's vested. And because we're talking about growth only, that's the $10 is the starting point. The company has to increase in value above the $10 for the employee to have value in the plan. So unlike phantom stock, a stock appreciation right only has value if the company goes up in value. It only has value to the participant. Whereas the phantom stock would have always been worth at least $10 if the company stayed at $10 in value. So let's move. The company goes up now to $50 a share in value. If you saw it, remember on the phantom stock slide, that was vesting. Vesting and a stock appreciation right generally is maybe exercise time, or it's predetermined that at a certain point you're going to get a chunk of value based on the growth. So here's the math. If the company grew from $10 to $50 a share, there's $40 a share of growth. And if that's the payout point in this plan, then the participant has $40 per share of income tax and FICA tax, by the way. So we can probably write that one right in there. And the company also has its share of taxes to be deducted at the same time. So I added in FICA on the slide, but it's, again, the same kind of concept as an option. Now, if this were just vesting and not exercise at that point, and let's say the share price went back down to $10 a share before it was payable, Well, again, with the phantom stock, there'd be $10 a share of value to pay out. If this SAR went back down to $10 a share, if the value of the business went down, at the time of payout, there would be no value to pay back to this person under a SAR. That's why business owners really like these plans, because of the link to business performance. So they're only paying if the value of the business goes up, much like a stock option that is worthless if the value of the stock doesn't go up in the public company world. So here's a real life case study of a company that used some phantom stock / stock appreciation right kind of plan design. This was a privately held company in the financial world. They had about $50 million of annual revenue. Again, not a giant company, good sized company, but not giant. They were concerned. They had a restructuring going on. Actually, what had happened is son had bought the business from dad. Dad had run the business fine, but in the last few years of Dad's ownership, he kind of hadn't paid attention to some things as much, and the company wasn't growing. So the son, who needed the company to grow to make his investment in buying the business from Dad pay off, needed to get things moving in a different direction. So there was some restructuring of senior managers, but then also retaining some and hiring new senior managers. But using real stock wasn't going to be a feasible piece of the transaction because son and dad had a relatively complicated buyout arrangement, and you didn't want to inject any additional non-family members into that arrangement. And because the company wasn't terribly profitable at the time, there wasn't additional cash available for compensation. So there needed to be a way to get people linked in to the upside of the business without having to try and put more money on the table today. So we helped them design a phantom stock plan that had kind of elements of both phantom stock and stock appreciation rights. Although this company, the son who bought the business, really wanted people to have some value, but it wasn't going to be vested for a while. So he did a lot of phantom stock with maybe some additional grants going forward. The grants contained a strike price, a grant price to begin with, and he actually gave small amounts of this phantom equity to everybody in the plan. But the biggest kicker was he wanted people to buy in and actually help the company with their financial situation. So he offered a matching amount, which provided far more value to people than the small basic grants, if they were willing to put some of their own money on the table. So he built this plan with a voluntary deferral feature like we've talked about, pre-tax contributions, but those contributions were buying more of the phantom stock. And then he also matched those contributions to increase the effect of having people have skin in the game, quote unquote. So he turned this company around pretty strongly with this plan design. The plan was based on growth in the value of the business, but even if the business didn't grow, there was still going to be some value. But the real leverage for everybody was growth. And it was planned to pay out if the company was sold or if people stayed all the way until retirement. So it wasn't going to be a near-term sort of get-rich-quick thing, but look, he said to his key people and people he brought in, I need you to help me turn this company around. I can't do it myself. And the only way this company is going to be worth something to me as the owner is if we turn it around. So I'm willing to share in that growth. He actually kind of mentally put 15% or so of the value of the business on the table through this plan. The formula in plans like this, and this is very common, if the business is actually sold, so now you have a real life value for the business because it's what somebody's willing to pay for it. That's the overriding value in the plan. But if there isn't a sale, if somebody leaves the company before there's a sale, then there's a conservative estimate made of the value of the business, and usually it's some form of, you've heard the acronym EBITDA, earnings before interest, taxes, depreciation, and amortization. Somewhere on the income statement, a company can find a line, whether it's operating earnings, just EBITDA, depending on the business. Find that line And then there's the marketplace pays for those kinds of earnings, and so most of these private company transactions are some kind of a multiple times that EBIT or EBITDA number, and that's how a conservative value is formed for plans like this, absent an actual sale transaction. So they set the plan up, and they were using a 5 times EBIT multiple, okay? And that was the conservative estimate. Folks would buy in, and if they left before the sale, they got bought out at that value, and they were successful. They actually took this all the way to measuring a phantom stock price, and they started at $7.63. Well, the company actually did sell, and they did not finance this plan with a trust or any insurance or anything else, but the company did sell about 7 years later, and they sold for essentially $87 a phantom share. So from less than $8 a share to $87 a share. It was about an 11 times increase. And everybody got to share, roughly 15% of that increase in value, plus the overall value, went to a group of, it turned out to be about 50 key employees in this business. The plan worked marvelously. The company did turn around, became wildly profitable. That's why they were able to sell for such an increased value. So, and that owner, the son, ended up growing his investment from his dad's business multiple fold. If the business went up 11 times and he shared 15% of it, he got to keep 8 or 9 times of that increase. So everybody won in that transaction. And the person who, I guess, didn't win, if you want to think of it that way, is probably Dad, because he had something he didn't know could be worth so much more. But that's a different generation of management and different level of energy and all those kinds of things. But that's the reason, that's how phantom stock plans can be very effective if used in the right scenario and in the right ways. So that is a clear indication that, again, we're not just helping rich people get richer. That was 50 people in a relatively smaller, mid-sized company. That company grew, the number of employees grew. It wasn't 50 employees that started in that plan. But again, these are not people who are making millions of dollars, but they got a nice size payout when their business was sold, even though they weren't actual shareholders. So hopefully that's another example for you of how these plans can work and how they get used in corporate America. Certainly very popular design, this phantom stock plan. I would say the last 5 to 10 years in my business, this is probably the most common discussion that we have with companies, how to share in the value of the business somehow with key employees without actually using real equity. And we've come to the final segue slide with the lovely Carlson School building in front of you. I certainly appreciate the chance to help share some information with you. On the next slide, I've got our contact information if you need a reminder about how to reach me, but thank you. And here's a final reminder of our contact information for how to get a hold of me: phone, email. I'd be happy to connect with you on LinkedIn. If you send me a LinkedIn note, please mention in the invitation, don't just use the standard one, mention that you are part of the class and that's why you'd like to connect. Mailing address, if you need to send a lengthy dissertation, I'm happy to review it and or be a part of that. But I thank you for your time. Hopefully you've been able to learn some things, and best of luck to you in the rest of this class and your career. Let me know if I can help in any way.